Hello, thank you for stopping by. We often receive a lot of questions regarding the difference between USDA rural housing loans and FHA mortgages. So we're going to take a couple of minutes today and just highlight some of the key differences between the two programs. If you're a home buyer and you have additional questions or want to learn more about either program, please reach out to us at usdamortgagesource.com or call us at 800-743-7556. Okay, first it's important to note that FHA and USDA, these are both very good programs, especially for first-time home buyers. They're both government-backed mortgages. FHA, of course, is backed by the Federal Housing Administration, and USDA, a different government entity, the U.S. Department of Agriculture and Rural Housing, they back those loans, and they're done through approved lenders and banks. Again, these are both secured loans with government backing. They're all safe, secure 30-year fixed mortgages. Some of the lowest interest rates available are for government home loans. That includes FHA, USDA, and VA loans. These programs, they do not have any prepayment or early payoff penalties. So they're really good loans in their own right. FHA is probably the most popular loan out there today for first-time home buyers, but USDA does have some advantages, which we'll look at if you meet the key eligibility components that USDA requires. We're going to talk about that in a second too. The first thing we'll highlight is the down payment. USDA is one of the last remaining programs today that doesn't require down payment. FHA does require a 3.5% down payment from the home buyer. That can be, though, in the form of a gift from maybe family members. So they do permit that for the down payment, but for USDA, it is 100% financing. And you don't have to do 100% financing with the USDA loan. If you're a home buyer and you want to put down maybe a 3 or 5% down payment, you're certainly welcome to do that with a USDA loan. It's just not required. Okay, so that's the first thing and probably the biggest advantage. The second thing is the one-time guarantee fee or funding fee or upfront mortgage insurance premium. There's different names for this depending on which loan program it is. But basically, this is a one-time fee that is commonly rolled into or added to the home buyer's loan. And it's required really for all government mortgages. For USDA rural housing, that fee is 1% of the loan amount that is added on top of whatever your final loan amount is. And for FHA, it's 1.75% of the loan amount. So we can see there the advantage goes to USDA. And just as an example, on let's say a regular $300,000 home that you are purchasing, just in the funding fee or the guarantee fee savings with USDA would be $2,250 just on that one-time upfront guarantee fee. Okay, so we'll look at next is the monthly mortgage insurance premium. Again, this has different names depending on what the program type. FHA calls it the mortgage insurance premium. USDA refers to it as the annual fee, even though it's paid out monthly. But most people know this as PMI, maybe is the most common term, private mortgage insurance or monthly mortgage insurance. But yes, the USDA loan, it is cheaper. You can see there the factor used for the USDA monthly mortgage insurance is cheaper than the FHA loan. And that FHA calculation there is based on the maximum financing of 96.5% financing. If you do put more money down for an FHA loan, that does come down a little bit lower. If you were to, put maybe a 5% down payment, that would come down. Or if you did a lower term, like a 15-year term instead of a 30-year term. But apples to apples for the max financing, the USDA is going to have the advantage there. For the credit score, FHA is going to have an advantage on this one. USDA is going to require generally a 640 credit score. That is for an automated GUS underwriting approval. GUS is basically the automated underwriting system that USDA and lenders use. USDA loans, there are options for buyers that may have lower credit scores, but those would require a manual underwrite for those. But FHA generally can go down for buyers that are financing 96.5% the maximum financing. They should have options available down to, in many cases, down to a 580 credit score, and even slightly lower credit scores for borrowers that do have a down payment, maybe a greater down payment of 5% or maybe a 10% down payment. That opens up the possibility for even lower credit scores than that. So there is a slight advantage there for the FHA loan on credit scoring. Okay, and then debt to income ratios. This is the calculation that's used for basically a buyer's housing expense ratio. It's how much the monthly cost is versus how much their gross monthly income is, and it's just a simple calculation. And FHA is they are more aggressive on how high they allow these ratios to be. USDA is pretty set on the housing and total expense ratios, but FHA again they have additional flexibility there and do allow for higher debt to income ratios. So that's going to be an advantage for FHA. Okay, so for USDA, we had mentioned there's two key components for eligibility, and this is the catch with USDA is that really two things. When it comes to eligibility, FHA does not have these eligibility requirements, but for USDA, the household income must be below the set limit per the county the property is located in. There's an income cap for the family, and it applies to all income producing members of the household, even if they're not on the loan application. Okay, so that is something to keep in mind. Is the income limits again depend on the location, the size of the household, and other factors, but generally for 2024, most families of 1 to 4 members, the income limits start at $110,650, and then they, for larger households of 5 or more family members, the income limits get closer to 150,000. And again, that can be much higher if you're in a high-cost location, a high-cost area, maybe parts of California and the Northeast certainly allow for even higher limits. But that's, again, income limits, and then also the location of the property. The property must be located in a USDA approved rural area according to the eligibility map. You can find the links here to the income calculator and to the eligibility map on our website at usdamortgagesource.com. But the property must be in an approved area. It doesn't matter who's selling the home. It just matters where the home is physically located. And again, most of the areas in the main city centers of big cities, they will not be eligible or approved for the USDA program. But don't be surprised, there are a lot of suburban locations that you may not think are rural in nature. Those can be approved. So it's always a good idea, again, unless you're in the main cities of large cities, you can check an address for eligibility relatively quickly. And again, there's instructions and other videos, if you just look here on our page, other videos that walk you through how to use the income calculator and then also how to use the property eligibility map. But those are the two really the key factors. As far as qualifying for the loan goes, that's separate. USDA and FHA, both when it comes to qualifying, those things are relatively the same when it comes to, you have to document all your income. You have to document, your assets and your job history and, maybe rental history. Those things really are pretty close to similar, with both programs. But again, USDA is the one that just has these two critical components with eligibility. So, um, if you look at which loan is the better option, well, if you do have your income that meets the eligibility requirements and you're in a location that is eligible, USDA will be the better option when it comes to the financing. But again, it just depends on where you're going to live and some of the other factors. But if you have questions, again, please reach out to us. That wraps everything up. Again, you can call us at 800-743-7556 or visit us at usdamortgagesource.com 7 days a week. Thank you for listening.